From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, a blowout payrolls report in America following another choppy week in the Treasury market. Fed Chair Jay Powell is not for turning. We begin with the big issue, a taperless tantrum.
People who are uncomfortable are bond market participants like myself.
I am very nervous.
It's not a miscommunication nor a misunderstanding.
Rates are going to keep rising.
Financial conditions are still exceptionally loose and easy.
Until we get that disorderly market functioning.
How the Fed reacts to a rapidly accelerating economy.
It's really the long end that I think is going to sort of try and force the Fed's hand.
The back end of the curve has a lot of room.
The Fed is going to has a really high bar to hike, but to taper.
The rise in interest rates.
Whether the 10-year is 150.
The Fed is not uncomfortable.
We heard from Chair Powell that he wasn't worried about the moves.
5 basis points of steepening a day.
Corners of the market are questioning how patient the Fed can exactly be.
We didn't get that support.
The Fed needs to start communicating.
The market's going to tantrum some more.
Let's bring in the team. Lafayette College's Krishna Mamani, Alliance Bernstein's Gershon Distenfeld, and Jim Bianco of Bianco Research. I want to begin with that line from Jeff Rosenberg of BlackRock. It's not a miscommunication or a misunderstanding. Krishna, do you agree with that?
Yes. So everything is working out according to Fed's plan. The economy is doing well, expected to do even better. Financial conditions are relatively easy still, very much so. And you just have to look at credit spreads to come to that conclusion. So why would they kind of show their hand too early? They only have to show their hand if there is a significant issue for the economy rather than the equity markets. And so far, everything is looking really good.
Right now, the tally's in twos, Gershon. I'm looking at the story right now. 14 basis points on twos, the 10-year yield at about 156. If yields are going higher because the data's better at the long end and the 2 years anchored, isn't that what Chairman Powell wants?
Well, I don't think he wants to go up too much because that's going to undo a lot of what needs to still be done. Remember, corporate borrowing has gone up a tremendous amount. Usually goes down in a recession, whatever you call this last period, it's gone up. I got to say, Jonathan, it's really great to have fixed income back in the news, but I think that people are way too fixated on short-term movement in rates. The key questions actually have nothing to do with the short term. It's what's the economy going to look like post-COVID? How much of the supply has been destroyed at this point, and how fast is it going to come back?
When you say that, Gershon, do you mean what's the difference between the reopening in the next several months and what's the difference between the shape of the cycle? Can you give me some more color on that?
Yeah, so look, there's no question that in the initial stages of the reopening, you're going to end up having a lot of demand. So we still have close to 10 million people, less jobs in the economy than there were pre-COVID. You also have had the highest savings rate in maybe ever since data was recorded, certainly the largest increase in 20 years. You're going to have all this pent-up demand. Even people with, people that are going to get jobs, people with jobs have been staying home and not doing things. The problem is on the supply side, right? Sporting events are only going to be open at 25%. Not all restaurants are going to be open. It's going to take time for business travel to come back and all that. So there's going to be a mismatch. That's probably going to lead to higher inflation in the short term. The real question, though, is what happens in the long term? How much permanent damage has been done to the economy?
Jim, just build on this for us as well. And let's just start with that story. Looking across the curve right now, is there a challenge for the Fed as far as you can see?
Yeah, I think there is a challenge for the Fed. If you look at the middle of the curve, the belly of the curve, and I'll go into the weeds a little bit. If you look at swaption volatility in the 2 to 5 year sector of the curve, that is the volatility or the uncertainty that the market has about 2 to 5 year rates. It's back to the peaks it was during the pandemic, and it's very close to where it was at the Powell pivot. Great uncertainty in the market at that point. If you look at the Fed fund futures, they're actually pricing in the first Fed rate hike for the June 2022, a little over a year from now. The market is worried about inflation. The market thinks the Fed is going to be forced to act sooner than they need to. Now, sooner is a year from now, not immediately. It's not going to be 2 or 3 years like the Fed likes to think. That's where I think the unsettledness comes from. While I agree that normally higher rates should be a welcome thing to financial markets because it suggests real growth, there's some lingering fear that these higher rates are being driven by inflation, And that's why you're seeing the market, especially in the middle of the curve, starting to price in much higher volatility, uncertainty about the Fed, and you're seeing things like the stock market wobble every time we see long rates go up.
I want to pick up on two words you used, inflation, worries. Krishna, inflation worries. What I've seen over the last couple of weeks is a bond market being driven by real yields, and I'm trying to understand the inflation piece of this. I get it. The base effects kick in. Energy prices are higher. Food prices are higher. Demand comes back online. We have some supply constraints. Are they inflation worries, Krishna, as far as you're concerned?
Well, so I think from a cyclical standpoint, because of the points that Gershon was making, that there is probably a cyclical uptick in inflation. And Powell basically said it just as much. But the real issue for the Fed and the real issue for the markets from a longer term perspective is what is inflation going to look like on a secular basis? And, that is what would inflation look like in 2022 and 2023. And the driver for that is really not the structural underpinnings of the supply side of the economy, at least not on the good side. It's really on wages. And I think if you expect wages to continue to rise on a sustained basis and not just in 2021, we're talking about 2022 and onwards. If that is what your expectation is, inflation is going to be real. I just don't see it. I think, from a secular standpoint, all the things that we faced in 2019, we still face. It's just that we had a substantial drawdown, and now we are coming out of it. And the temporary income replacement is certainly helping the economy grow out of it. But that temporary income replacement is going to start fading in 2022. And we'll be back to where we were before, talking about secular stagnation and everything else that we used to talk about.
Steve Major of HSBC shares that view with you, Krishna. And here's the view from PGIM. Robert Tipp, a colleague and good friend of yours, I'm sure, guys, saying the following. As growth drops off next year, it's going to become clearer that the Fed is not going to be hiking as rapidly as what's priced into the forward curve, if at all, maybe for the next handful of years. Jim, I'd like you to come back in. Can you respond to that?
Yeah, I think that Christian's really summed it up very well in that we've got a lot of stimulus being pumped into the economy fiscally. There's $21.5 trillion of personal income that we, all Americans, generate every year. The vast majority of that comes from wages. Right now, a quarter of that is being mailed to us from the government in the form of stimulus checks from the $900 billion from the old CARES Act, and coming soon is $1,400 checks as well, too. That's where you're getting the immediate wage inflation. Let's call it personal income inflation. The next question then becomes, is that done? We've sent 3 checks out. We've got Senator Romney proposing monthly checks to everybody who has got children under 17. Or is this the beginning of UBI? Because if it is the beginning of universal basic income, then I think the market is right to be fretting about inflation as we move forward from here. So it really comes down to all this stimulus. Is it temporary, or is it something more than just temporary? Right now, you could make the case it might be something a little bit more, because we're about to have our 3rd round of stimulus checks go out in the next couple of weeks, assuming everything goes as we expect in Congress.
Gershon, let's have the final word from you on this. Is it temporary, or is it a story that persists?
Without disagreeing with anything that Krishna or Robert said, I think we need to be honest and humble here. We are in unprecedented times. The past 12 months, we've seen, again, I don't know if you call it a recession, but we've seen 5 times the downturn of the average recession since World War II in a quarter of the time period. You lop on top of that the fact that, again, corporate borrowing has gone up. Usually corporate borrowing goes down in a recession. You have all this money sitting on the sidelines. We don't know the trajectory of the vaccine. It looks like it's good right now, especially in the US, but there could be variants out there. We are really in unprecedented times. And I think what the balance that the Fed is trying to get right now is, on the one hand, communicating to people not to panic. On the other hand, recognizing that they themselves have absolutely no idea when they're going to start raising rates, when they're even going to taper. So it looks like they're going to buy $1 trillion worth of bonds this year. So there's a lot of uncertainty. The Fed recognizes it, and we have to be humble in making sure that we don't really know exactly what's going to happen in the short term.
It's been a humbling 12 months. Guys, you'll be sticking with us. Coming up on the programme, up next, the auction block. Junk-rated companies borrowing at an unprecedented clip. That conversation coming up next. From New York, this is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe, where surging ESG debt sales are helping fuel the best ever start to the continent's market for new bonds. Italy's debut green offering was the most subscribed deal in Europe's primary market through the week. In the States, junk-rated companies setting a first quarter record this week, roughly $100 billion in sales fueled by first-time borrowers, taking advantage of their rising equity prices. And the high-grade market remaining well open as well, sales topping weekly estimates by Wednesday, with at least 45 issuers selling more than $65 billion in new debt. Back with us, Krishna Mamani, Gershon Distenfeld and Jim Bianco. Jim, I want to come to you, sir, on the auction slate, on the Treasury side of things. We had that ugly 7-year offering last week, and next week, I believe, we get 30-year and 10-year debt. Are you worried about the amount of supply coming to market over the next couple of months?
Not really for the next couple of months, because the Treasury has already pre-announced that they're going to pull it back and run down their cash balances. That's actually got me worried a little bit too, that we might see negative rates at the very front end of the curve. But longer term, just beyond the next few months, yes, because if we get stimulus, we already have a $3.5 trillion deficit. We could be looking at $4+ trillion deficits. And that's a lot of bonds that are going to have to be sold. Maybe not between now and June, but after June, I think there's going to be a lot more bonds that are going to be on the block. And unfortunately, what we saw with the 7-year last week might not be the last time we see something like that.
In a downturn like what we saw through last year, there's a lot of demand for that kind of debt. And I just wonder, Krishna, going forward from here, whether that competition for capital that some people think might materialize in the coming years starts to evolve soon. What's your take on that?
Well, so, if you look at the U.S. real yields, as we talked about earlier, they are significantly higher. So people overseas who need that, need that exposure, need those bonds, we are making more of them. So whenever someone talks about supply and demand imbalance driving Treasury markets, drives bananas. Because that's not what drives Treasury markets. I mean, for an auction, it may, but from a longer-term perspective, what drives the Treasury market is what your inflation expectations are and what the economic conditions are, so that we have an idea as to where both nominal and real yield should be.
Well, Krishna, to put a finer point on it, supply matters. It's what you think that supply will achieve. Do you think this additional supply leads to that growth, that inflation?
Supply certainly matters, but the fact of the matter is that if there is a substantial rise in yields and because of that supply concern, then the equity market will tumble. And then all of a sudden, people who are buying equities will become buyers of bonds. So that eventually works out, and that's how the markets work.
Do you think, Gershon, that high yield's the relative winner here?
Well, the technicals are phenomenal. People are going to need yield. It's important to note that, spreads are not crazily tight. The ultimate yield, the yields are pretty low. And that's going to be the same debate we've been having for a long time. What matters more, the yield or the spread? I would just like to comment one thing on the Treasury market, sure, which is very concerning to me, much more so than the supply, is the liquidity in the Treasury market. We saw earlier this week bid offer spreads on the 30-year go out to like 10 to 12 ticks. That is not something we've seen before. Even the most liquid point, the 5-year point, you would have had a hard time doing more than 500 million at a clip. That is concerning more so than the supply. We need to make sure, if we're going to have all this debt, the Fed's going to be buying a lot of it, we're going to be issuing a lot more of it, there has to be an orderly, transparent, and low transaction cost Treasury market.
Do you think then, Jim Bianco, that's what the Fed needs to be focused on here? The volatility, the illiquidity of the last couple of weeks?
Yeah, I do think that they need to be worried about it. I agree with Gershon. If you look at the history of central banks that do QE, and if you look at the extreme example of Japan, that their central bank, the Bank of Japan, now owns about 45% of their market, where the Fed owns in the low 20s right now. Their liquidity is almost non-existent. They have whole days where benchmark issues don't trade in that market at any great degree, if at all. And that's what usually happens when you get a very large footprint from a central bank in a market. They kind of nudge out everybody else. In fact, we might even be seeing it in the TIPS market right now in the U.S. with some of the liquidity issues that we've been noticing that have been coming in that market because of the heavy involvement that the Fed has had as well, too. So, yeah, you should be very, very worried about the liquidity issues moving forward. They're not going to get better if the economy continues to advance, and they're not going to get better if inflation concerns still are on the forefront of everybody's mind.
If those liquidity issues lead to volatility, doesn't that offer some kind of opportunity as the year progresses, Gershon?
Well, volatility is always the friend of the active investor. So, we've been sitting here for the past few months, not having really strong provocative views. We'd love some volatility. Right now, it's steady as she goes. It's looking at, credits. If you go back to the high yield market, credits that look quite attractive, but the pricing is not great. And we're going to see that for a while. One interesting thing in the investment grade market, which we don't talk about a lot, is for the first time in, I don't know how long, decades, you can buy high quality companies below par. I mean, for years, we were looking at those, old issuance 5-6% coupons that you had to pay $140 price on a bond. Today, you can buy a company like Amazon, for example. You can buy the debt of Amazon in the 80s. And that's because the yields have gone up recently and they've had very low coupons. So there's some interesting convexity opportunities in the investment grade market that we haven't seen in quite some time.
I want to pick up on some of those opportunities. There was a battle several years ago on this program, I'll call it a battle, between Gershon and Krishna over leveraged loans and what would perform better. I believe it was about 2.5 years ago, and I believe I've been informed that Gershon was right on that one, Krishna, that high yield outperformed leveraged loans over the next 2.5 years. As you see things right now, Krishna, what are you more comfortable with, the loan story or high yield?
Well, Gershon won a temporary battle, but he may have lost the war. No, I'm kidding. The point with respect to that is I think credit markets are attractive overall, and I think both loans and high yield are quite attractive, and Gershon was kind of alluding to that. And from a Fed's perspective, from a credit creation perspective in support of the economy, that is a far more important metric than Treasury market volatility, to be honest. I mean, they're worried about Treasury market volatility, but that may have been driven primarily because of repositioning, because everyone was on the same side of the boat. And then all of a sudden they decided to move to the other side with the steepening trade. So credit spreads are quite stable and the Fed is laser focused on it. And therefore all credit spreads, including loans and high yield, depending on your proclivity, is attractive. I would go back to the original statement that I made to Gershon in that episode, which is loans really aren't about duration. I think if it is about duration, there are 15 different ways of managing the duration of your portfolio. The valuation issues really is more about spreads relative to the underlying credit risk. And I think everything looks pretty good at the moment.
Final word, Gershon.
As much as I'd like to disagree with Krishna, I agree with everything he just said. All credit is attractive. My view 2.5 years ago wasn't that loans weren't attractive. It's that high yield was much more attractive. And quite frankly, they've both done very well. High yield's done better, but they've both done very well. I still think there's a lot of opportunity. And prudent investors are going to look across both markets to figure out where the best opportunities are in each.
That was very graceful, Gershon. Thank you, sir. Everyone's going to be sticking with us. Coming up on the programme, still ahead, the final spread, the week ahead, featuring a slew of US economic data and an ECB rate decision. That conversation up next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, the OECD publishing its interim economic outlook on Tuesday. Then we get CPI readings from the US and China on Wednesday, an ECB rate decision and President Christine Lagarde news conference on Thursday. And we round out the week on Friday with US PPI with some final thoughts, I'm pleased to say. Still with us, Christian Mamani, Gershon Diston founder Jim Bianco. Jim, let's pick up on the ECB and President Lagarde next Thursday. Different proposition for them when they see yields higher compared to, say, Chairman Powell. They seem to be much more uncomfortable with it. What can they do, Jim?
I think that they're setting the stage that they're going to increase their PEP purchases, and they've already kind of said that. And I think when Lagarde has a presser, that's going to be the basic thing they're going to talk about is now that the month is end, because remember, the ECB has to set their PEP purchases every month. They just did that. Now it's going to be about how you're going to execute it. Give me some ranges on, say, the 10-year bond, where you're going to come in, how you're going to come in. What ranges would you look at if you were going to start moving the discount rate or any of that other stuff? But I really think it's going to be about where is your pain point that you'll step in with your purchases.
Have you been confused, Jim, by what they've been doing over the last couple of weeks? Because the public commentary's been one thing. Behind the scenes, looking at the data, it doesn't look like they stepped in even if they were uncomfortable. Why?
It goes back to what I said before. You have to set those pet purchases at the beginning of the month. They did that at the beginning of February. By the time the markets got a little bit wobbly at the end of the month, they were out of authority to really buy bonds. Well, the good news is March 1st came, and they could now reset that authority to buy bonds once more time. It's unfortunate that they have such a difficult kind of bureaucracy in deciding how they're going to do their purchases. And I think a lot of people might have misread that as a lack of commitment or uninterest because it happened to come at the last week of the month when they were pretty much out of authority to buy bonds.
Final segment, guys. I've been told off the last couple of weeks by my producer for running down the clock too much and missing out on the rapid fire round. So let's get there now. 3 questions, 3 quick answers, and start with this one right here. I want to do this just to see, not because I think it's going to happen. The first rate hike, I want to understand from you three where you think that comes. 22, 23, or low for a whole lot longer. Which one, Krishna?
I think 23 earliest, but low for long.
Gershon?
23, mid-23.
Jim?
22.
Going to be really interested to see how those numbers evolve. 22 from Jim, 23 the others, maybe longer. Here's a final one for you. Have we seen the low for the 10-year this year already? 91 basis points, yes or no? Gershon?
No, definitely
Krishna?
not.
For this year, yes.
Jim?
I go with yes.
Guys, great to catch up with you all. Krishna Mamani, Gershon Distenfeld, Jim Bianco, thank you, sir. That was 2, not 3. I know, we're out of time. From New York City, that does it from us. We'll see you next Friday at 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg.